Ladies and gentlemen, in today's video we dive into the secret code behind the price charts. Candlestick patterns. Signals smart money can't hide. We've already seen what candlesticks are. Now we'll explore how combinations of candlesticks tell stories. Reversals, continuations, traps, strength, weakness. By the end you'll recognize patterns clearly, know when they matter, and avoid false ones. Let's unlock this next level. A candlestick pattern is a specific arrangement of one or more candles that repeatedly appears in price charts, giving clues about future price action. Patterns are tools traders use to interpret market sentiment, the battle between buyers and sellers. These patterns are categorized by single candle, two candle, three candle, etc. They help in identifying potential turning points or confirming trends. Reversal patterns suggest that the current trend is weakening and may change direction, for example, from rising to falling or vice versa. Continuation patterns, by contrast, show that after a pause or minor correction, the prevailing trend is likely to resume. Recognizing whether a chart shows a reversal or a continuation is essential, since it changes your strategy and how much risk you're willing to take. Single candlestick patterns are formations created by just one price bar on a chart. The shape, including the size of its body and wicks, reflects the battle between buyers and sellers during that period. These patterns can signal potential shifts in market direction or moments of indecision, depending on the trend leading up to them. While they are easy to spot, they aren't always reliable on their own. Traders usually look for additional confirmation from what happens next or other market factors to avoid false signals. Here are the key single candlestick patterns. Look at the chart below. Price has been going down for several candles. Then this candle appears with a very long lower wick, much longer than its body, and a small body up near the top. That is a hammer. It shows that during this period sellers pushed price down hard, but buyers came back enough to bring it up near the open. Now observe the next candle. If it closes above the high of the hammer, that gives evidence that buyers might be taking control. That could mean the decline is ending and price may begin rising. Here, on this chart, after a down move you see a candle with a long upper wick, small body near the bottom, and little or no lower wick. That is the inverted hammer. It tells us bulls tried to push price up, but couldn't fully keep it there. There's a struggle. If the very next candle closes higher than this one's high, that strengthens the idea of a shift upward. That might signal a reversal starting. Now look at this portion. Price has been climbing. Then comes a candle with a small body near the bottom, a long upper wick, and little lower wick. That's a shooting star. It means buyers pushed price up during the candle, but by the end sellers pushed back down towards the open. The next candle is important. If it closes below the body of the shooting star, that suggests sellers may be gaining control and the uptrend could be about to reverse. Here's a candle where open and close are nearly the same, the body is tiny, and there might be shadows, wicks, above or below. That's a doji. It signals indecision. In this period neither buyers nor sellers dominated. If this shows up after a strong move up or down, then the next candle's behavior matters. If it confirms the direction opposite to the move, you might expect a reversal or at least a pause in the trend. See this candle. Small body, wicks both above and below that are longer than the body. That is a spinning top. It means during that period there was volatility. Price moved up and down, but ended close to where it began. That suggests the momentum of the current trend is weakening. Again, watch what happens next. The following candle's direction can help clarify whether price reverses or consolidates. Now look at this candle. It has a very long body and almost no wicks. It opens near the low and closes near the high, or vice versa. That is a marubozu. It shows strong conviction by either buyers, in bullish version, or sellers, in bearish version. When you see marubozu during a trend, it often means the trend is likely to continue with force in that direction. Now we will learn about two candle patterns. These formations are created by the relationship between two consecutive price bars on a chart. By analyzing how these two bars interact, such as their size, position, and the way they overlap or differ, we can gain deeper insights into market sentiment and potential trend changes. Like single candle patterns, two candle patterns can help identify possible reversals or continuation signals, but they often provide stronger confirmation when combined with overall market context. Here are the key two candle patterns. A bullish engulfing pattern is a two-candle reversal signal that forms during a downtrend. The first candle is bearish, and the second is bullish, completely engulfing the body of the first candle. This indicates a shift in market sentiment from selling to buying pressure. Look at the chart below. Notice how the second candle's body fully covers the first, suggesting a potential reversal to the upside. A bearish engulfing pattern appears after an uptrend and signals a potential reversal to the downside. The first candle is bullish, and the second is bearish, entirely engulfing the first candle's body. This pattern indicates that sellers have taken control. Observe the chart below. The second candle's body completely engulfs the first, hinting at a bearish reversal. The piercing line is a bullish reversal pattern that forms after a downtrend. The first candle is bearish, and the second opens below the first's low but closes above its midpoint, indicating strong buying interest. Look at the chart below. Observe how the second candle closes above the midpoint of the first, suggesting a potential shift to the upside. The dark cloud cover is a bearish reversal pattern that appears after an uptrend. The first candle is bullish, and the second opens above the first's high but closes below its midpoint, signaling a shift from buying to selling pressure. Examine the chart below. Notice how the second candle closes below the midpoint of the first, indicating a potential reversal to the downside. A tweezer top is a bearish reversal pattern found at the end of an uptrend. It consists of two candles with nearly identical highs, the first being bullish and the second bearish. This pattern indicates that buyers attempted to push the price higher but failed, suggesting potential selling pressure. Look at the chart below. Notice how both candles have similar highs, hinting at a possible reversal to the downside. A tweezer bottom is a bullish reversal pattern found at the end of a downtrend. It consists of two candles with nearly identical lows, the first being bearish and the second bullish. This pattern suggests that sellers attempted to push the price lower but failed, indicating potential buying interest. Refer to the chart below. Observe how both candles have similar lows, signaling a possible reversal to the upside. The bullish kicker is a rare and powerful bullish reversal pattern. The first candle is bearish, and the second opens above the first's high and closes significantly higher, indicating a sudden shift in market sentiment from selling to buying pressure. Observe the chart below. See how the second candle opens above the first and closes much higher, signaling a strong potential for upward movement. A bullish harami is a two-candle reversal pattern that occurs during a downtrend. The first candle is large and bearish, followed by a smaller bullish candle entirely contained within the body of the first. This suggests that selling pressure is weakening, and buyers may be gaining control. Look at the chart below. You'll see a long red candle followed by a smaller green candle nested within it, indicating a potential reversal to the upside. A bearish harami is a two-candle reversal pattern that appears during an uptrend. The first candle is large and bullish, followed by a smaller bearish candle entirely contained within the body of the first. This indicates that buying momentum is weakening, and sellers may be starting to take control. Look at the chart below. Observe a long green candle followed by a smaller red candle contained within it, signaling a potential reversal to the downside. Now we will learn about three candlestick patterns. These formations consist of three consecutive price bars whose combined shapes and positions reveal deeper insights into the ongoing battle between buyers and sellers. By studying how these three bars interact, through their size, order, and wicks, we can better understand potential trend reversals or continuation signals. Compared to single or two candle patterns, three candlestick patterns often provide clearer confirmation but still work best when considered with the overall market context. Here are the key 3 candlestick patterns. A morning star is a 3-candle bullish reversal pattern that forms after a downtrend. The first candle is a long bearish candle, indicating strong selling pressure. The second candle is a small-bodied candle, or doji, showing market indecision. The third candle is a strong bullish candle that closes well into or above the midpoint of the first candle, confirming a shift in momentum. Look at the chart below. You'll see a long red candle followed by a small-bodied candle and then a long green candle, indicating a potential reversal to the upside. An evening star is a 3-candle bearish reversal pattern found after an uptrend. The first candle is a strong bullish candle, continuing the upward move. The second is a small-bodied candle, or doji, reflecting uncertainty. The third candle is a strong bearish one that closes well below the midpoint of the first candle, confirming that sellers have taken over. Look at the chart below. Observe a long green candle followed by a small-bodied candle and then a long red candle, signaling a potential reversal to the downside. The 3 white soldiers is a strong bullish continuation or reversal pattern that appears after a downtrend or consolidation. It consists of 3 long-bodied bullish candles, each closing progressively higher. Each candle opens within or near the body of the previous candle, and ideally, the wicks are small, showing that buyers controlled the session from open to close. Look at the chart below. You'll see 3 consecutive green candles with small or no wicks, indicating sustained buying interest and growing confidence among bulls. The 3 black crows is the bearish equivalent of the 3 white soldiers, forming after an uptrend. It consists of 3 long-bodied bearish candles, each closing lower than the last. Each candle opens within or near the previous candle's body and closes at or near its low, indicating persistent selling pressure. Look at the chart below. Observe 3 consecutive red candles with small or no wicks, signaling a strong shift from bullish to bearish sentiment. A 3 outside up is a strong bullish reversal pattern that begins with a small bearish candle, followed by a bullish engulfing candle that completely overtakes the first, and a third bullish candle that confirms the trend reversal. This 3-candle structure reflects a transition from weakness to decisive strength. Look at the chart below. You'll see a small red candle followed by a large green candle and then another green candle, indicating a potential shift from bearish to bullish momentum. An abandoned baby is a rare but very reliable 3-candle reversal pattern. The first candle follows the prevailing trend, bullish or bearish. The second is a doji or small body candle that gaps away from the first, appearing isolated. The third candle gaps back in the opposite direction, confirming a strong shift in sentiment. Look at the chart below. You'll see a candle in the prevailing trend, followed by a doji that gaps away, and then a candle gapping back in the opposite direction, signaling a potential reversal. A falling 3 methods is a bearish continuation pattern within a strong downtrend. It begins with a long bearish candle, followed by several small bullish or neutral candles that remain within the range of the first candle, signaling a pause or consolidation. The final candle is another strong bearish candle that breaks below the range and resumes the downward move. Look at the chart below. You'll see a long red candle followed by several smaller candles within its range, and then another long red candle breaking below the range, indicating a continuation of the downtrend. Congratulations on completing our deep dive into candlestick patterns. You've learned how these single, 2, and 3 candle formations act as powerful storytellers of market sentiment. Remember, context is key. Always consider the surrounding price action to validate these patterns. In our next video, we'll explore the foundational concepts of support and resistance, where price tends to bounce or break through. Understanding these levels is crucial, as they often coincide with key candlestick patterns, providing powerful trade signals. By mastering support and resistance, you'll unlock the ability to identify high-probability trade setups and enhance your trading strategy. Stay tuned, and I'll see you in the next video.